If you were born before 1966, there is a very high probability that you are either already receiving your Canada pension plan and old age security payments, or you are close enough to those dates that the decisions you make in the next 12 to 24 months will determine the financial shape of the rest of your retirement. And I am going to tell you right now, at the very beginning of this video, that most Canadians in your position are making at least one significant mistake with these benefits. Not because they are careless. Not because they are uninformed people. But because the rules around CPP and OAS are genuinely complicated, because the government does not proactively explain the strategies that would benefit you most, and because the decisions that feel most intuitive, the ones that seem obvious on the surface, are very often the exact decisions that cost Canadian seniors the most money over the course of their retirement. Today I am going to change that. My name is Robert Marshall, and in this video I am going to walk through the most important CPP and OAS warnings that every Canadian born before 1966 needs to hear right now in 2026. I am going to explain why the age at which you claim these benefits is one of the most consequential financial decisions you will ever make. I am going to show you the calculation that the government runs, and that most seniors never see, that determines exactly how much lifetime income you are giving up or gaining based on when you start collecting. I am going to explain the GIS trap that destroys thousands of dollars in benefits for seniors who have RRSPs and do not know the one rule that would protect them. I am going to cover the survivor's pension mistake that costs widowed Canadian seniors money every single month. And I am going to tell you about the OAS deferral strategy that the vast majority of eligible Canadians completely overlook, and that can increase your monthly payment by up to 36% for the rest of your life. This video is long. It needs to be, because these are not simple topics and you deserve a real explanation, not a 30-second summary that leaves you more confused than when you started. Get comfortable. Take notes if you can. Because what we are going to cover today is worth more in real dollars to your retirement than almost any other financial conversation you will have this year. Let us begin with the most fundamental decision in the entire Canadian retirement system, and the one that is most frequently gotten wrong. When to take your CPP. The Canada Pension Plan allows you to begin collecting your retirement pension as early as age 60. You can also delay it as late as age 70. And the difference between those two endpoints is not small. It is not a minor adjustment at the margins. It is a difference of up to 78% in your monthly benefit amount, and that difference compounds over every month for the rest of your life. Here is exactly how the math works. If you take CPP before you turn 65, your monthly payment is reduced by 0.6% for every month before your 65th birthday. That means if you take CPP at 60, the earliest possible date, your payment is reduced by 36% permanently. It does not recover when you turn 65. It does not reset. That reduction is locked in for life. If you wait past 65 and delay your CPP, your monthly payment increases by 0.7% for every month after your 65th birthday. That means if you delay until 70, the latest possible date, your payment is 42% higher than it would have been at 65. 42% more every single month for the rest of your life. Now let me put real numbers around this so you can feel what that actually means. The average monthly CPP retirement pension for a new recipient in Canada in 2026 is approximately $830. Let us use that number as our baseline, the amount you would receive if you claimed at exactly 65. If you claimed at 60 instead, that $830 becomes approximately $531 per month. A reduction of nearly $300 every single month. Every month for the rest of your life. If you delayed to 70 instead, that $830 becomes approximately $1,179 per month. An increase of $349 every single month. Every month for the rest of your life. Those are not trivial numbers. Over 10 years, the difference between claiming at 60 and claiming at 70 represents more than $77,000 in total lifetime benefit payments, and that is before accounting for any CPP cost of living adjustments, which are applied annually and which mean the gap compounds even further over time. So why do so many Canadians take CPP early? I hear the same reasons consistently. They say, I have worked my whole life for this, I want to start collecting it now. They say, what if I get sick, what if something happens, I want to make sure I actually use it. They say, I need the money now, my expenses are higher right now than they will be later. And I understand every one of those reasons. They are human responses to a complicated system. But I want to address each of them directly. The argument about wanting to collect what you have earned is emotionally completely understandable but mathematically counterproductive. Taking CPP at 60 does not mean you collect more money over your lifetime. It means you collect it sooner, at a significantly lower rate. The total lifetime amount depends entirely on how long you live. The break-even point, the age at which delaying to 65 pays more in total lifetime income than starting at 60, is approximately 73 to 74 years old. The break-even point between starting at 65 and starting at 70 is approximately 82 to 83 years old. The average life expectancy of a Canadian who reaches 65 is now 84 years for men and 87 years for women. The majority of Canadians who delay their CPP will live past the break-even point. Most people who claim early are, statistically, leaving money on the table. The argument about health uncertainty is valid for a specific group of Canadians, those with a serious existing health condition that meaningfully reduces their life expectancy. If your doctor has told you that you have a condition likely to affect your longevity, claiming CPP early may genuinely be the right financial decision for your individual situation. But for the majority of Canadian seniors born before 1966 who are in reasonable health, making a permanent 36% reduction in a government benefit based on a hypothetical health concern is a significant financial sacrifice that is rarely justified by the outcome. The argument about needing the money now is the most legitimate of the three, and it is also the one I want to address most carefully. Because here is the thing that most financial conversations about CPP timing completely ignore: the decision about when to take CPP does not exist in isolation. It exists within the context of your entire financial picture. Your RRSP balance. Your TFSA room. Your other income sources. Your spouse's income and pension situation. For some Canadians, strategically drawing down an RRSP in the years between retirement and age 70, using RRSP withdrawals to cover living expenses while delaying CPP, produces a dramatically better long-term outcome than claiming CPP immediately at 60. This is a strategy called RRSP meltdown or bridging, and it requires individual calculation to determine whether it applies to your situation. But the point I want to make is this: if your reason for claiming CPP early is purely that you need monthly income before 65, there may be alternative sources of income worth exploring before making a permanent reduction to one of your most valuable lifetime benefits. Now let us talk about OAS. The Old Age Security Pension is the second pillar of the Canadian retirement income system, and it comes with its own set of rules, warnings, and strategies that most seniors born before 1966 have never been properly explained. OAS begins automatically at age 65 for Canadians who meet the residency requirements. You do not have to apply in most cases. Service Canada automatically enrolls eligible Canadians and sends a notification letter several months before your 65th birthday. The maximum monthly OAS payment in 2026 is approximately $718 for recipients aged 65 to 74, and approximately $790 for recipients aged 75 and over, a higher rate that was introduced in recent years specifically to provide additional support to older seniors. Here is the first OAS warning I want to give you. If you are approaching 65 and you have not received an enrollment letter from Service Canada, you need to contact them proactively. The automatic enrollment system does not catch everyone. Canadians who have lived abroad for portions of their adult life, Canadians whose records have any kind of administrative discrepancy, and Canadians who have not filed recent tax returns are among those who sometimes fall through the automatic enrollment process. Missing even 3 months of OAS payments because enrollment was delayed costs you over $2,000 that you are never guaranteed to recover. Do not assume it is coming. Confirm it is coming. The second OAS warning connects directly to something we discussed about CPP, and that is deferral. Just as CPP can be delayed past 65 for an increased payment, OAS can also be deferred. For every month past 65 that you delay starting your OAS, up to a maximum of 60 months at age 70, your monthly payment increases by 0.6%. At the maximum deferral of 5 years, your OAS payment is 36% higher than it would have been at 65, and that increase is permanent and pensionable for the rest of your life. For Canadians who are still working past 65, or who have other sufficient income in their early retirement years and do not need OAS immediately, this deferral can represent an extremely valuable long-term strategy. But here is the nuance that most people miss: deferring OAS only makes financial sense if your current income in the years between 65 and 70 is low enough that the OAS income would not be particularly helpful anyway, or high enough that receiving OAS during those years would push you into OAS recovery tax territory. Which brings me to the OAS clawback, officially called the OAS recovery tax, and this is something every Canadian born before 1966 who has any significant income needs to understand clearly. If your net world income in any given year exceeds a certain threshold, in 2026 the threshold sits at approximately $93,000, you are required to repay a portion of your OAS, at a rate of 15 cents for every dollar of income above the threshold. At an income level of approximately $151,000, the entire OAS payment is clawed back. You receive nothing. For most Canadian seniors, this threshold is comfortably above their retirement income. But for seniors who have significant RRIF withdrawals, investment income, rental income, or other income sources in addition to their pensions, this can become relevant. And the key planning insight is this: the income that triggers OAS clawback includes RRSP and RRIF withdrawals. Which means that seniors who have large RRSP balances and who delay drawing them down until their mandatory RRIF conversion at age 71 can suddenly find themselves in a position where their required minimum RRIF withdrawals push their income above the OAS threshold, and they lose OAS payments they could have protected with earlier, more strategic RRSP drawdowns in the years before age 71. This is one of the most common and most costly retirement planning mistakes I see Canadian seniors make. And it is entirely preventable with the right strategy applied before the mandatory conversion deadline. Now I want to talk about something that affects a specific group of Canadian seniors born before 1966, and that is the GIS trap. The Guaranteed Income Supplement is a non-taxable monthly benefit paid to low-income OAS recipients in Canada. It is means-tested, which means the amount you receive is calculated based on your income from the previous year. And for seniors who are GIS recipients and who also have RRSP balances, there is a trap that can cost thousands of dollars in a single year if you are not aware of it. Here is how the trap works. Let us say you are a Canadian senior receiving GIS. Your income is low. Your GIS payment is meaningful. And you have a modest RRSP balance that you have been contributing to for years. In a given year, you need additional funds, perhaps for a home repair, a vehicle, or a medical expense, and you make an RRSP withdrawal to cover it. That RRSP withdrawal appears on your tax return as income in the year you make it. And because GIS is calculated based on your prior year income, that single RRSP withdrawal can dramatically reduce, or in some cases completely eliminate, your GIS payments for the entire following year. Not for a month. For a full year. Until the GIS recalculation the following July when your new income is assessed. For some seniors this means a reduction in monthly income of hundreds of dollars over 12 consecutive months, in direct response to a one-time withdrawal that they made for a completely legitimate reason. And the most painful part is that it is irreversible once the withdrawal is made. You cannot undo it. You cannot refile your tax return to remove it. There is a partial solution that some seniors do not know about, and that is the current year income election. If your income drops significantly compared to the prior year, for example, if the prior year RRSP withdrawal was a one-time event and your income is now back to its normal lower level, you can apply to Service Canada to have your GIS recalculated based on your current year estimated income rather than waiting for the prior year assessment. This does not eliminate the damage entirely, but it can shorten the period during which your GIS is reduced. If you are a GIS recipient and you are considering any kind of RRSP withdrawal, contact Service Canada before you make that withdrawal and understand exactly what the impact will be on your monthly benefits. I want to close with the survivor's pension, because this is a warning that specifically affects Canadian seniors who have lost a spouse, and it is a situation where thousands of dollars of legitimate benefit money is lost every year simply because the rules are not widely known. When a CPP contributor passes away, their surviving spouse or common law partner may be entitled to receive a portion of the deceased CPP as a survivor's pension. The amount depends on the survivor's age, their own CPP entitlement, and the calculation method used by Service Canada. And here is where the warning becomes important. The CPP does not automatically combine your own CPP retirement pension with the survivor's pension in a way that pays you both in full. There is a maximum combined benefit cap. And for survivors who are already receiving their own CPP retirement pension, the survivor's pension is integrated with their existing CPP payment in a way that often produces a much smaller combined benefit than most people expect. What does this mean practically? It means that if you are approaching retirement and you and your spouse are deciding when to take your respective CPP payments, the order and timing of those claims affects not just your income now but the survivor's pension that the remaining partner receives if one of you passes away first. This is a calculation that genuinely benefits from being modeled before the claiming decisions are made, not after. Service Canada can provide an estimate of survivor benefits. Ask for it specifically. Because the claiming age decision for a couple is not two separate individual decisions. It is one joint decision with long-term survivor implications that most couples never consider until it is too late. If you were born before 1966 and you are still in the planning stage for any of these decisions, when to take CPP, whether to defer OAS, how to manage your RRSP before the RRIF conversion, how to protect your GIS, the most important action you can take right now is to log into your My Service Canada account at canada.ca and pull your CPP statement of contributions. This document shows your entire lifetime CPP contribution history and gives you an estimate of your monthly benefit at age 60, 65, and 70. It is the starting point of every informed retirement income decision. And if you have a spouse, pull theirs as well. Look at them side by side. Understand what you each have, what you each are entitled to, and what the survivor implications look like for both of you. This is not complicated information to access. It takes 15 minutes to retrieve. And it can change every financial decision you make for the rest of your retirement. The Canadian pension system was built to support you. CPP represents decades of your own contributions, money you put in every working year of your life. OAS represents your eligibility as a Canadian resident who contributed to this country. GIS exists specifically to ensure that the lowest income seniors do not fall below a basic income floor. These are your benefits. Every dollar of them. But collecting them intelligently, at the right time, in the right sequence, with the right tax strategy wrapped around them, is the difference between a retirement that feels secure and a retirement that feels like you are always one unexpected expense away from difficulty. You deserve the secure version. And you deserve to have someone explain these rules clearly enough that you can actually make them work for you. That is what this channel is here for every single week. Subscribe, because next week I am going to walk through the RRSP to RRIF conversion deadline in detail, what it means, what the mandatory withdrawal rates are, and exactly how to structure your withdrawals in the years before 71 to protect both your OAS and your GIS from the income spikes that catch so many Canadian seniors completely off guard. This is your pension. Your benefits. Your retirement. Make sure you are getting every dollar of it.